Good afternoon, everyone. Welcome to HW&Company's webinar series. This session is on employee retention credits and everything you need to know about employee retention credits. My name is Tony LaNasa. I'm a principal at HW&Company. We also have Jim Horkey, who's a colleague and principal at HW&Company as well. So hopefully you've seen us with previous webinars with a lot of this different relief that has been provided by the government and others. With that, Jim is going to get into the agenda and an overview of the ERC.
Thanks, Tony. Hello, everybody. So our goal today is really, we're going to give you a little background and overview of the employee retention credit and touch on some of the application procedures if you find yourself in a position to take the credit. But our main goal today is to walk you through some steps to help you determine if you either can get the credit or if possible you can get the credit and you need to follow through. Because it's relatively complex, and we find that oftentimes it's hard to determine where to start and how to walk through this process without getting off track. So a little bit on the background, the ERC is what I'm going to call it the rest of the webinar here, is a refundable payroll tax credit. Initially became law as part of the CARES Act that dates all the way back to March 2020, and that's when Tony and I got involved in the payroll protection program and other stimulus parts of the CARES Act. It is a new law. However, it's similar to previous refundable payroll tax credits that are related to more traditional disasters like hurricanes. What's really, but it's different. It's got its own set of rules, and the sheer magnitude of it covering the entire country makes it very different. Now, when it first became law, there was a lot of confusion with it, and the truth is a lot of people just didn't care because initially you couldn't take the employee retention credit if you were also participating in the payroll protection program. So for the vast majority of our clients, they didn't have an interest. So then in December 2020, as part of the Consolidated Appropriations Act, the employee retention credit was expanded, and now a large number of employers across the country are now eligible. Really the big change was it opened it up to companies, even if they did participate in the payroll protection program. You can't use the same wages, but for many companies, that's not going to be a real hard issue to get past. And then most recently, through the American Rescue Plan Act of 2021, it was further expanded. Back in December 2020, it was expanded and also carried through to through the first half of 2021. But then recently, it was expanded to the entire year of 2021. So, one of the places to start is, well, what kind of guidance and rules as accountants we're used to, filling out forms. Well, really, there isn't any forms that, however, there are some information that's on the IRS website that helps you guide you through the process, and then ultimately it's a refundable payroll tax credit. So you simply claim the credit on your 941 or amended 941 return, or there's a few other ways you can do it, which we'll talk about later. But as far as what can I rely upon, well, originally you can still, originally the CARES Act, while it's been subsequently superseded, there's still a lot of original law within the CARES Act that still applies. I'm not recommending anybody try to read the CARES Act. When the CARES Act came out back in March of 2020, the IRS initially put out quite a bit of guidance in the form of like 94, question and answer format FAQs that are no longer current, and you can still find them on the IRS website. However, they clearly state that they're no longer current. You can also rely on the December 2020 law that came out, which retroactively amended the ERC. The most recent information that you can rely on is there's an IRS notice 2021 that was issued in March of 2021. And it was well received, it's well written, it's fairly easy to follow, and has some very good examples in it. It's 102 pages, but it's actually reasonably readable. And then even more recently, that 2021-20 notice specifically applies to the credit for the year 2020, while the new IRS notice 20, which is issued 2021-23, the rules apply to the first half of 2021. As far as the most recent extension through the end of 2021, no guidance has been issued yet for that extension, and for some of the expansion that's included in the extension. The guidance that's clearly out there now is really what you want to focus on, and that's what our presentation today is really taken from, is the guidance that's issued by the IRS. And it is guidance, and the good news is that you can rely upon it to some extent, and if you do rely on it, ultimately you have some protection because you can't generally get penalized if you rely on IRS guidance.
And there's a lot of interpretation out there from other firms, law firms and other, that are interpreting the CARES Act a little differently, potentially from the IRS and what the guidance is out there. So you'll see, some interpretations that potentially could be a little different than the guidance. And not saying it's wrong or right, but you just have to. There is a lot of judgment in this law, in this act, and based on the credit and the qualifications of credit, you may have to make some judgments on your own and determine that and document, and defend yourself and support yourself related to your judgment based on the credit. So, and we'll talk about that throughout. First polling question I'll launch here. So about, a good portion of you, have enough to be dangerous, which is good. And then, about a fifth of you, not much at all. So hopefully a good portion of you learned something from the session today. Okay, so moving into step one, we actually have these slides based on kind of like the process you need to go through related to determining if you qualify, and then just all of the other items that you need to really determine with the credit itself. So really the first step is really just understanding, well, did you have an operating trade or business in 2020, okay? And if you didn't, then you don't qualify, right? So there is some exceptions, and we have this bonus at the bottom here with these special rules for startup businesses, but ultimately, if you didn't have a business in 2020, then you don't qualify for the credit in 2020. But you can see some detail here that kind of discusses, nonprofits are actually eligible for the credit. You think, well, why would a nonprofit be eligible for a tax credit? Well, because it actually reduces your payroll taxes. So, nonprofits are eligible. The only thing here that it mentions here is the self-employed individuals are not eligible. However, if you're self-employed and you have employees that work for you, that potentially they would qualify, that those wages would qualify for the credit, and you can actually take the credit as long as your business qualifies under the qualifications for the credit. So again, this is pretty simple stuff here, but step one is really determining if you did operate in 2020.
Okay, thanks, Tony. So the next thing I feel is important to do, especially for clients that have multiple businesses, is that you have to look at this as an affiliated group. So an affiliated group comes down to, can be affiliated on control or on ownership, which is more likely. So if you have, let's say you control 5 companies, well then you're going to have to look at the whole group and do calculations based on the whole group. And then individually the companies apply for the credit based on their portion of it. However, the calculations are done in whole. And those calculations that are done as part of an affiliated group are determining the number of employees that you have, which has a major play on whether you're a large or small employer, which makes a big difference on the credit that's available to you. It's going to be used for calculating if you had an appropriate revenue decline, and it also matters if you are. It's also looked at as a group if you're fully or partially suspended. And we're going to talk about all three of those things separately, and we'll probably remind you when we're doing that you have to look at it as a whole. Now, we could probably talk for a long time about what makes an affiliate group, and I put in the middle here on a link to the code sections, and then a link to where you could go on the IRS if you want to read a lot more about it. But however, it comes down to like a classic 50% common control test. And, the control is based either on ownership, common ownership, and has a number of rules related to, what family members are considered the same person versus other family relationships may be considered separate. And then it comes down to control. You have one board that controls multiple entities. So we won't going to get any more farther into that, except at the beginning of this process, you have to decide, are we looking at this as one company, or are we looking at all five at the same time?
Yeah, and the IRS, like the code sections and all that, it really alludes to for-profit entities, business entities. It doesn't really speak on nonprofits. But as Jim mentioned, you really need to look at control of your organization, based on the board and the board vote and so forth, because there might be a little bit of judgment there for the nonprofit side. But typically, if you have the control of the board, if you have the same management managing entities, if that's the case, normally there would be some sort of an affiliation group then. And then you would have to aggregate, those entities together to determine all of these qualifications. So just make sure that you're doing that right. So, Jim mentioned, considering the large and small employers, this is very important based on just the credit itself, because it will determine how much of a credit you can get based on the wages that qualify. So, to determine this, and this guidance is coming from the IRS. So, there is some interpretations that are potentially could be different here. But what the IRS is saying is if you look at 2019 employees and you determine your full-time employees for 2019, and that's going to determine if you're going to be a large or a small employer. And you can kind of read the details here. It kind of follows the Affordable Cares Act and what they determine related to what were full-time employees for that. But you can see, 30 hours per week, 130 hours per month. So what you do is you just run your hours analysis by employee for 2019. You average it out by employee for per week, per month, and then you determine your full-time employees based on that. The last couple bullets here, it just discusses if you weren't in operation all of 19, you just use the months that you were in operation 19, as well as 20. If you were just, in operation for a part of 2020, you just use the hours you were in operation of 2020 and determine the actual full-time employees for that. Okay. But again, this is very important because this will determine how much of a credit you can get based on the qualifying wages. And, how you determine that is first, based on the calculations, it is for a large employer, it is more than 100 employees for 2020. And for 2021, it's more than 500 employees, okay? And you'll see some differences between the 2 years, 2020 and 2021, because based on what Jim was saying with some of the final acts that were actually approved in late 20, it made some changes overall to 2021 and the actual qualifications for that. But again, moving back to that, the large employer are those numbers 100 or more for 2020 or 500 or more for 2021. And then for a small employer, it's 100 or less for 2020 or 500 or less for 2021. So based on your calculations, you determine that, and then that's going to place you either in a small employer or a large employer. And we'll talk about what that means here in a second. But in either of the cases, we'll talk about this later too. The qualifying wages, we'll talk about. Jim actually talks about this later. Is it's capped at $10,000 per employee, and for 2020, it's capped at $10,000 per employee for the whole year. But for 2021, it's capped at $10,000 per employee per quarter. So you can see the significant increase potentially in the credit for 2021 for qualifying employers. But for the large employer, going back to the large employer, if you do qualify for the large employer, you can only use wages for non-service employees. What that means is for employees that are not working for you. So they're either furloughed, they're on sick leave that you're not getting credits for, other credits for. They're potentially on vacation, and you're actually not paying them related to that potentially. So it's a big distinction between the two. Small employers, if you qualify for small employers, it is all wages. So all wages pay would be qualified for this credit. And again, obviously, it would cap it at the $10,000 based on each year, 2020 and 2021. So next is another polling question. We had a question that came out. It was, is it mandatory to use the quarter date comparison 19 to 20? Our business started impacted from COVID fourth quarter of 20 compared to first quarter of 21. And I believe it is. I think there's really no way around that. Comparison with the gross receipts, you have to compare back to 19. And it's going to be the same quarter of 19.
There is a special rule, which is coming up next.
Yeah, we'll talk about a special rule on that.
And just to be clear, Tony, it's like if you're a large employer, you can only get the credit for payments to employees for not providing service back. And there are some scenarios that maybe everyone's not thinking about on that, and we're going to hit on those a little bit later.
Okay. So, Sherry, so it looks like a good portion of you on this call potentially will. So, either in 20 and 21 or one of the years and all that. So that's good.
All right. So the clearest path to the employee retention credit is simply a gross receipts test. So it's completely mathematical, and for the most part, most businesses can calculate this on their own, and oftentimes, we're seeing that being done, and they're kind of running it by us. They're letting us know that they're getting the credit. So when you're looking at 2020, you need to be able to document a 50% decline, so the credit starts in the first quarter of 2020, with a caveat that it's for wages paid after March 11th, 2020. But it starts with the first quarter where you have a 50% decline in revenue compared to 2019. And then it continues until you hit a quarter where you've got 80%. You're only down. You've recovered 80% of those gross receipts. Now you're only down, in essence, only 20%. So that's completely mathematical. It doesn't matter if you still made money. It doesn't matter if ultimately you recovered those sales in the fourth quarter. It's completely mathematical. So once you hit that, it's mathematical. You do your calculation and you take the credit. For 2021, it's a much easier test. It's only a 20% decrease for the quarter in 21 versus the same quarter in 2019. And once again, the first quarter that you get it, you continue to get it until you have a quarter where you've recovered 80% of those revenues. So generally, if you get it for one quarter, you're gonna get it for the next quarter, and if you recover in that quarter, then it stops. So, and we'll talk a little bit more about the calculation later. Now, there's a special rule for 2021 where you can measure the decline using the immediately preceding quarter. Example, you would use you'd use the first quarter. For the first quarter of 2021, you could use the fourth quarter of 2020.
And that's a question that came up.
Which is what Tony just alluded to.
So that, that question is that, you can use that special rule.
So if you can't hit the mathematical calculation, then your next step is to move on to looking at the full or partial suspension of operations criteria, which is much more complex. But one question that I'm sure to come up is, how are gross receipts defined? And Tony's going to talk about that.
Yeah, so gross receipts, here it's defined between, for-profit business entities and tax-exempt entities, but really in the end, it's really all gross receipts that are included in the business. And we've gotten a lot of questions related to healthcare providers, and if you include the provider relief funds, the coronavirus relief funds, and other grants and other relief that a lot of the healthcare providers received and other businesses. And we just got clarification, probably I would say about a month ago, that you do include that in gross receipts for 2020. So if you think about it, a lot of the healthcare providers, what you do include all of that relief, it knocks you out. So it knocks you out of this qualification for gross receipts potentially when you compare it back to 19. So again, I think a lot of businesses potentially might be looking at the other qualification, which we'll get into here in a little bit. But again, that's a clarified item there. For tax-exempt organizations, you can see you do include contributions, you include gifts, bequests, grants. So like I said, most gross receipts that are received, you're going to include this in the calculation for both years to be consistent. Now, the only thing that was clarified way back when was you do not include PPP or EIDL. So, businesses that received that and potentially got forgiveness and so forth on it, you do not include that in gross receipts. Another polling question, do you think you can qualify under the gross receipts reduction? We just got a question about the stimulus and including in gross receipts. So that, yeah, definitely, like I said, you will include all that relief in 2020 gross receipts. Okay, I'm going to close it here, share it. Okay. So a good portion of you will qualify for both for one of the years, probably in 21 potentially, and then a good portion of you think you don't. So the information that we will be discussing here soon will be important for about half the audience here.
Okay, so I drew the most interesting part of this presentation, which is, how to qualify for the employee retention credit based on being a full or partial shutdown. So, in essence, if due to government order your business was fully or partially suspended, then you can qualify for the credit while that suspension is taking place. Okay. Now, everybody knows if you're fully suspended or shut down. There were lots of businesses, gyms, certain kinds of restaurants that were fully shut down, and I don't think there's any doubt or complexity to that. If you were, partially shut down, or your business was partially suspended, there's certainly some very clear cases there as well. Think of the easiest example are bars and restaurants. They had to close at 10 o'clock instead of 2 in the morning, and those kind of issues were relatively clear. However, beyond some of the more obvious examples, it gets very complicated, and you really have to think it through. And the good news, I guess, is there are a lot of good examples and information on the IRS website at this time. There has not always been a lot of good information out there. It's fairly recent. So, for employers experience a partial shutdown, they kind of laid out, four circumstances that you have to address. And you don't have to address all of them. Really, any of them can get you over the line to get the credit. So, if you have critical suppliers that are forced to suspend their operations due to government order, and it's usually always going to be due to government order to really hang your hat on something. Then if your suppliers are shut down, in essence, you're shut down as well, and you'd be qualified for the credit during that period. If your operating hours are reduced due to government order, then that certainly opens the door for you to get the credit. If your operations are subject to modification due to government order, well, that's another one that there are some good examples, but it's also certainly that if you can think of the thousands of scenarios, everything is not addressed in the guidance. And one thing to keep in mind is, as we remember back to, especially back to April, June, July, back in 2020, if you were an essential business, many of the orders did not apply to you. So, and the IRS guidance is very specific that if it didn't apply to you, you can't count it. So, so you have to keep that in mind. Whether you're an essential business or not makes a big difference. And then if you have multiple locations and you have a similar type business and you have partial suspension, full or partial suspension in one jurisdiction, then you can get you may be able to get the credit for all your locations. The IRS really laid out three circumstances where you do not get the credit, or at least this can't be the reason you get the credit. If your customers were required to stay home, or otherwise because of the pandemic your business dropped, your demand for your business and services dropped, that's not a valid reason. If you voluntarily suspended your operations, that's not valid. And if you're able, like a lot of businesses, to move your businesses from in-house to remote, and you were able to pull that off and continue to operate in a comparable manner, that's not considered a partial shutdown.
And the one to highlight here is that the operations, this is under the employers may experience partial suspension, as the operations are subject to modifications due to a government order. I think a lot of businesses can probably fill into that bullet there, because there was modifications, there was restrictions from state, from Department of Health and Human Services, CDC, and all of that that potentially could qualify you. So again, as we mentioned earlier, you really need to kind of take a look, step back, and really understand, well, what's all of the restrictions and modifications of government orders out there. And then again, as I mentioned before, it's really a judgment. Really, okay, well, is this impacting us? And if it's impacting us, how much did it impact us? And then from there, then we determine, okay, well, what's our story? Can we have a narrative behind it that actually, tells us that we do qualify for this credit? And we talk about documentation later on. You have to if you do think you qualify for this credit, you're going to have lots of documentation behind you supporting that position. So make sure you are supporting that position with documentation, because again, in a couple of years down the road, and if something occurs where the IRS comes looking, you're going to want to be like, here's all our documentation. This is why we qualified, and this is why we think we were able to take the credit. So make sure you're doing all of that. Some of the government orders, you can probably read through the first couple bullets here in detail, but the last bullet here talks about orders from city mayors, state orders on emergency orders, residents staying in place, which obviously was here in Ohio for a while. Local items, curfews, as Jim mentioned before. As I mentioned before, all of the agencies potentially, HHS, CDC, OSHA, they had restrictions put in place potentially for businesses. So there is hundreds and hundreds of orders out there that potentially could qualify you. So again, making sure that you understand that, and then determining, can I qualify for this credit based on that order? Okay. So
important concept to understand is that if you're an essential business or a non-essential business. So if you were considered an essential business and you didn't have any, in the shutdown orders didn't apply to you, then you can't necessarily use those orders as a reasoning. However, if you're an essential business that had a partial suspension of certain part of your operation, under the facts and circumstances, if that part of your business that was suspended that maybe wasn't essential, then the concept is if that's a more than nominal portion of your business, then you're considered suspended under government order anyway. A good example might be, I think this is a good example, a grocery store. Grocery stores were clearly essential. Their business was actually booming. They were open. Many locations, they were not required to change their hours necessarily. So that grocery store, you would think, well, they're essential. They weren't impacted by any, directly shut down by any orders. However, what if that grocery store also had a restaurant on premises? That's fairly common, actually. And if that, and Tony's going to get into later, what is a nominal portion of your business. But if that restaurant was a nominal portion of the business, then that could open the door then for that business to get the credit. Similarly, if an employer maintains both an essential and non-essential business, and both operations are more than nominal, then you may be considered to have a partial suspension of operations if the order restricts only the non-essential part of the business. So that's a key item. And essential, I'm kind of reading it, but essential business that's permitted to continue in operations may be considered to have a partial suspension of operations if the government order, requires that business to close for a period of time during normal working hours, which was a very common event for a lot of our clients.
So getting to this nominal portion impact, and again, this is coming directly from the IRS, which is guidance. So, it is guidance, but there is a different interpretation based on what nominal means. But based on what the IRS is saying, it's this 10% nominal impact. So, really long story short, you can read all this, but long story short is if the business has a 10% or more overall impact based on an activity that was restricted, right? So you had an activity that was restricted, it was 10% or more impact to the overall business, then the IRS guidance says that would qualify as more than a nominal impact to the business, which then potentially could qualify you for the partial suspension shutdown. Okay, so if you read the notices, this information will come directly out of those notices. But again, as I said before, there is different interpretation out there, so you'll have to kind of make your judgment on that.
So, from a supply chain point of view, you can be you could be fully or partially suspended if your key suppliers are suspended. Seems fair and clear. On the other side of it, though, if your customers are fully suspended, it doesn't give you ability to use this as a reasoning for being partially or fully suspended. But if you think about it logically, then if your customer demand is way down, or your customers that you sell to are suspended, then you would fall back on the gross receipts test, and that's really where you would have to circle back to. So, Tony, you want to talk about multiple locations?
So if you have multiple locations, I think we had a question on this somewhere. If you have multiple locations and you had orders that impacted one of the locations, however, you're actually following those rules or those restrictions business-wide, then that would qualify you potentially, obviously, as like the partial impact, partial suspension, and all of that. And then I think Jim is going to talk about later about how that could impact then the credit to the overall business too, because then if it's only just one location, it actually would then qualify you for the whole business potentially, the partial suspension, and then you can take the credit on. Again, as I said before, if you're a small employer, you can take the credit on all qualifying wages paid to employees during that period of partial shutdown or full suspension. So do you have any other comments on that?
I'm going to kind of tag team onto that.
Yep.
So, the last kind of thing to bring up on this step is that if you're part of an aggregated group, now, when we talked about it earlier, being part of an aggregated group probably hurts you as far as your employee headcount and being considered, especially for 2020, when the bar is only 100 employees, it might have hurt your ability to get the credit. However, for 2021, where 500 is the bar to be considered a small employer, being an aggregated group actually for some companies could be helpful, because whatever the group on a whole, whatever the situation is for the group on a whole is, then everybody in the group gets it. So let's say you have 3 companies, very different companies, all part of an aggregated group. One has a record year, and one's mediocre, and one has an awful year, and they can all, when you do all the calculations together, you qualify for the credit, or if one of those groups is fully suspended and the other 2 aren't, you get the credit for the whole group. And that's a concept that's hard to wrap your head around, but it's very clear in the employee retention credit guidance and law that's how it works.
And that that relates to if you just have one business, but you have different activities in that business, and one activity is considered a partial shutdown or full shutdown. As Jim was mentioning before, different businesses are doing different things. They have a restaurant inside, they have different things as well. If that restaurant was shut down, then it qualifies the whole business for it, and you would be able to take that credit for the period of that shutdown, that partial shutdown, for the whole business, not just that activity itself.
Yeah, which is hard for us to conceptually wrap our head around, but that's how it reads.
Okay.
Tony, I'm going to leave you the hard part of calculating the credit.
So Jim was mentioning like mathematical calculation. For the most part, once you qualify yourself, which it is, I think we've gotten lots of questions about, well, what wages can you use? Well, if you've gotten other relief, other credits, well, you can't use those same wages for ERC. So PPP, if you're using wages for PPP, you're using wages for PRS for healthcare providers, you're using wages for the work hour opportunity credits, the FFCRAs, all that stuff, then you can't use those same wages. Okay, so you have to really track all of that, just like you were before when you were tracking all the relief and how you're using it. You'd have to track the wages being used for ERC as well, and make sure what they call is make sure you do not double dip. Jim?
So yeah, Tony, one thing we're seeing amongst our clients is that the double dip issue is not much of an issue for clients where their employees are higher compensated, because it's that first 10,000 of wages where it really becomes a bigger issue for our clients that have a lot of minimum wage or lower wage employees. That's where you can really hit the double dipping, because you're not over 10 grand on it, because all this is done on an individual employee basis.
Right, and that's the next point here. You really have to look at it per employee, because the wages is based on the max cap of 10,000 per employee. So you look at it per employee, and then if you're looking at it, if you do qualify under the gross receipts reduction, then again that's going to be by quarter. If you qualify under the partial suspension or full suspension, then that's going to be based on the period of your suspension or your shutdown. So that could be either less than a quarter, or it could be beyond a quarter as well. So again, just make sure that you're doing that properly. We didn't talk about health insurance costs, but health insurance costs paid by the employer are eligible as well as the wages. So employer paid health insurance is includable, as well as if you're self-insured, you have to have some sort of reasonable allocation method, to the employees. But if you have some sort of reasonable allocation method to the employees, then you can include any employer-paid self-insured health insurance as well. So again, making sure you do that.
Yeah, as long as you're bringing up health insurance. One interesting scenario is, let's say you're a large employer and you're listening today and you're saying, well, this doesn't apply to me. However, more common than not scenario, I guess, is, many large employers, may have cut people's hours at different points during the pandemic. However, they didn't cut their benefits, so they didn't cut their health insurance benefits. Therefore, there's an example within the IRS guidance that if you cut your staff by 75% hours, you cut them from 40 to 30 hours, but you didn't cut their pay, well, then technically you're paying 25% of their benefits for not providing service. So that 25% is, you can get the credit on that.
I think, Jim, you're stealing my thunder. That was my next bullet.
Was it? Oh, I should have probably looked at that.
All right, Jim, keep going.
All right. Well, I stole your bullet. Sorry. So the credit percentage itself, this is fairly straightforward. It's 50% of the first $10,000 paid per employee. For 2020, it starts with wages paid beginning with March 12, 2020, and so in 2021, it's much more lucrative. It's 70% of the first 10,000. So for it's a $5,000 max per employee in 2020, and it's a $7,000 max per employee per quarter in 2021. So if you think of the magnitude of this, if you're a company with 100 employees and you can qualify for the whole term, that's $33,000 per employee times 100 employees is $3,300,000. So that's just huge. Even a small company with 10 employees that can qualify for the whole period, that's $330,000. So we're definitely talking about some pretty big numbers here.
Yeah, definitely some large numbers in 2021 for sure. So, you qualify, you make your calculations. Well, how do you get the credit? Okay, so there's a few options. If you make your calculation based on a quarter and you did not file your 941 yet for the quarter, you can claim it on your 941 and reduce your payroll taxes on the 941. You can also, if you do that, then, you can also then not, like going forward, then you can just reduce your payroll taxes that you pay in on a per pay basis based on the credit that you calculated. So that's kind of like, almost real-time cash impact because you're not going to wait for a check from the IRS. So there's a couple options there that you can do. You can file this 7200 form, IRS 7200 form, and it's an advance payment of those credits. We generally don't recommend that because, with the IRS and the issues with the IRS with even for just processing returns right now, there's going to be a very significant delay in time with filing that 7200 form and then receiving the check. So we generally don't recommend that. Probably try the other options potentially. And then if you have to go back to 2020 and they actually get a credit based on prior year 941s, then you would actually have to amend your 941. It's a 941X, amend it, and include the credits that you're claiming for that quarter, and then file that 941 at that point. Okay, so there's a few options there that you can take. One of probably the best approaches we would think is, because you're going to get the cash almost immediately, is just potentially just reducing your payroll taxes going forward. The payroll taxes are only the employer portion. So the employer portion of payroll taxes, and it's the FICA side of it that you're paying in.
Good point, Tony. So other important considerations, which primarily are all income tax now related, which always makes my tax partners nervous when I start talking about income taxes. But one thing to keep in mind is that if you file for the credit after you filed your income tax returns, then you may have to go back and amend those returns. the credit itself reduces the deductible portion of your wage expense, and it's for the year the wages were paid. However, there is some open question out there of how this is treated for a cash basis taxpayer versus an accrual basis taxpayer, and we're expecting some guidance on that relatively soon, as this is starting to become an issue, as we are beginning to now see companies that have got the credit that have not yet filed their returns for 2020. One big thing to keep in mind is if you decide to later file for the credit after you filed your return, you definitely could fall into a scenario where you have to amend your return, and where it's really a big issue is going to be for some of our clients that are partnerships and S corporations that have dozens or even hundreds of K1s affecting individual tax returns. There's some other, I'm not going to get into the real detail, but there's other considerations as well, including things like if you're getting an R&D credit, the wages that you claim for that credit can't be the same wages that you claim for the employee retention credit, and so on. So that's really one thing to keep in mind. And so while you have a long time to think about claiming this credit, you also have to consider, should I rush to file my regular return?
All right, the last polling question: do you think you'll qualify for ERC? We've gotten some questions. There's a handful of questions. Do you include realized or unrealized gains or losses on investments? I believe you would include realized. I don't think you would include unrealized, because again, that's more of a non-cash. It's unrealized as a player. But once you realize a gain or loss, then you would include it. When does the special rule go into effect? That's that preceding quarter. I think that's for 2021, right, Jim?
Right. That's a special rule, and the IRS has a one-page notice out on that.
Yeah. I think that's for 2021.
Yeah. If you're looking at getting a credit for the first quarter of 2021, you want to look at the fourth quarter of 2020 as well.
Yep. Do you look at gross receipts based on accrual or cash basis, tax basis? I think it's really based on how you do your reporting, right? So
it goes by, if you've always been a cash basis taxpayer, you can't switch to accrual basis to get the credit. You have to stick with what you always have been.
What if only one of your service areas is limited? I think we already mentioned that if you did have a restriction or all that on one service area, that could qualify you. Again, you may look at that nominal impact.
Right. You have to go back to 2019, and was that service area more than 10% of your revenues in 2019? And if not, then it would be considered nominal, and according to the IRS's website, would not qualify.
We had a question about adult daycare. Obviously, that was fully shut down for a good portion, and then obviously it went then to limited capacity. So again, sort of that same sort of thing. You want to look at just the impact to your business. That 10% rule is an IRS guideline. It could be again other judgment, other interpretations as well. So you want to look at that. Probably talk to your CPA just to see if that would qualify.
Right. It seems on the surface that we're trying to walk you down the path to, is this something that I think I might qualify for? And that certainly on the surface would appear that it falls in that basket.
All right. Share the poll here. So a good portion of you think you do, and then a good portion of you at this point are not sure. So you'll have to kind of sit back and do some calculations on your own, and hopefully you do. So a couple things that expanded the ERC here recently. This is severely financially distressed employer. This is only related to the last 2 quarters of 21. You can see it here. There's a 90% decline compared to 19. So obviously very significant impact. The recovery startup business, we mentioned this a little earlier. There's some special rules about recovery startups. in 2020, and if you can qualify for the credit as well, you can read that on your own as well.
But the main thing to keep in mind is there's no guidance yet on these two issues. On these two, they seem relatively clear on the surface. However, we're certainly expecting, a notice to come out on this piece as well. So
we just included just a handful of questions that we're getting from our clients here, and I know there's lots of questions coming through as well. So hopefully some of those questions that are coming through right now, the ones here may answer some of those. But I had all or most of my employees work from home in 2020, but really nothing changed as far as impact. Do I qualify? For the most part, probably not.
Well, I guess the answer is maybe, but not based on that. Right. Not based on that. Not
based on the IRS guidance.
Yeah.
So again, you'll have to look at it really what the impact to you was. Now, if you look at that nominal impact, hours are included in the impact. So if you had a reduction of hours based on going remote, and it was considered that more than nominal impact, then potentially you could qualify, right? So there's different things there's lots of options out there that you can look at and that you can determine if you do qualify for this. What period of wages do I use for gross receipts reduction? Again, as I mentioned before, it's really just the time that you are well, for gross receipts reduction, it's based on a quarter, okay? And then for the partial suspension, it's based on the time period that you were under that federal government order or restriction and partially suspended. There was a question that was submitted about the PPP. You already submitted your PPP loan forgiveness application, and you put all these wages on there, and that was the time when you did. It was before the December Act that was approved that gave that approval for businesses to use the ERC that use PPP as well. Well, if you say, for example, you had a $100,000 loan and you put $200,000 of wages in the loan application, well, you can use the excess wages for ERC as long as you're documenting it and documenting that you used $100,000 for wages for PPP and then $100,000 excess wages that were originally on PPP loan forgiveness for ERC. I think you would be fine doing that.
You are.
Just make sure you're doing that.
Clearly, that's very taxpayer friendly.
Right.
Ruling that the IRS made.
We talked about the health plan expenses, ERC taxable. I think Jim kind of sort of talked about that already with the.
It's not completely free, but yeah, it affects your taxes. So you get
right.
this credit. That's not income, but to the extent you got the credit, you can't still take the deduction. So you're offsetting the credit against your wages. And then
can the IRS audit us? Yes, they can come and audit you. I think it's 5 years. I think I read it was 5 years.
Right,
they can come out and audit the ERC. We talked about documentation, making sure you have all this documented, you have this in a file or electronically, making sure that if the IRS does come out, you have all the support behind it as far as a narrative of your story of impact, why you qualify. If it's gross receipts, again, obviously a little bit easier because you have that's all mathematical. If it's partial suspension, again, having that story behind it of how you were impacted, why you think you qualify, and having that ready potentially if the IRS came knocking.
Yeah, Tony, as far as, the audit fear question, honestly, nobody knows what the IRS is going to do. However, I guess if we had to make a guess, we would guess that they're going to target industries where maybe on the surface you wouldn't think anyone in that industry would have gotten the credit. So that's kind of our best guess at this point. We don't think they're going to target restaurants because they're pretty much obvious. Other industries where they're essential employers, we think that could be a future target.
Right. And then that last question about the 941 and how long you have to amend it, it's 3 years. So, it's 3 years from the actual filing of that 941 where you can amend the 941 with the 941X. So you do have some time here. But again, as Jim was talking about, who knows what changes could happen here later on this year once we sort of get out of this kind of COVID world potentially. So there could be changes later on that potentially could impact you negatively. So you may want to get this in when you can potentially now if you do qualify.
So yeah, thanks a lot, Tony. I think we're at our stopping point. We've run out of time. we certainly want to be a resource for anybody that has any questions. So send your questions, give us a call, contact your HW&Co rep if you're a client, and we're here to help.
Okay, thanks everybody.